Hey everyone, welcome back to REIT Ball. This is M. Glad.
The Spurlock in the house.
We are back for another one. Today we're going to talk about capital markets with our guests. Really excited to have them on today, so stay tuned. What's up, everybody? We're back. Spurlock, how are you, man? Friday.
Another Friday. It's not as sunny out here where I'm at. It rained all night, but hopefully the weekend is a little better.
Yeah, me too. So welcome back, everyone. Happy Friday. If you happen to listen today, we're excited. We're grateful to have the guest today on REIT Ball, Justin Piasecki. So Justin is the principal of Avison Young, helping lead the debt, joint venture, structured capital, and loan sale group in the New York City office. Having Justin on today, it really helps round out the guests that we've had. So if you look back, we've had a REIT CEO for a public REIT. We've had a CEO and executive of a private real estate development firm. We've had a prop tech expert to talk about the future of real estate. And now we have Justin talking about capital markets with us. So this episode will really bring together some of the commercial real estate finance ideas that I've shared in past episodes, from leverage, debt, equity, the capital stack, and financing deals. You know, Justin creates the financing for deals on a daily basis and does a damn good job of it. He's been at it for a while. Some of his bio highlights include 2019, he was recognized as one of the top 50 commercial real estate professionals under 40 years old by Globe Street. He secures short and long-term financing for real estate transactions, and he's helped grow the Avison Young Capital Markets division since he was hired and joined the firm in 2012. Last year, some of his larger financing transactions include $220 million construction loan, $125 million and $86 million bridge loans. In 2017, he led a massive financing for the $450 million acquisition and reposition of the JCPenney's headquarters. Other transactions that Justin's been a part of are a $160 million land pre-development loan in Los Angeles and a $50 million hotel construction loan for the Brooklyn Marriott. In addition to capital raises and financing direct projects, Justin also facilitates the sale of loan portfolios, which I'm sure he'll discuss as part of the interview. So I'll stop talking there. We can bring in the man of the hour onto the show so we can drop some knowledge and for the listeners, and let's bring him in, Spurlock.
Let's get into it.
Hey guys.
Justin, welcome, man. Welcome to REIT Ball.
Thanks for having me.
Absolutely. Yeah. Thank you for your time today. So we talked a little bit about what we're going to cover, but for the listeners, you know, it's very exciting that Justin's really going to cover several topics. First, capital markets and defining what that actually means. COVID, you know, capital market trends versus 2019, short and long-term opportunities from his perspective, any advice for small operators as they try to raise capital, and then factoring in capital markets and how it will be impacted by future stimulus, elections, and potential vaccines as we wrap up the year and get into 2021. So, Justin, any questions before we officially kick it off?
No, I'm ready.
Ready? Are you nervous?
Nah. I do phone calls with billionaire guys all day long. So
so that means you're not nervous. You should be nervous when you're on.
I might be, but Mark, I've known you for 20 plus years, so I'm good.
So you're good. Well, thank you so much for coming. So I just want to kick it off first. Just tell everyone how you arrived where you are today at Avison Young, just your backstory, as well as, you know, these are beginners. The listeners are new to real estate and different concepts. If you could just explain what capital markets actually means and what you do on a daily basis as it pertains to commercial real estate.
Gotcha. So I guess I'll take a step back. So I grew up, you know, with Mark in a town called Voorhees, New Jersey, right outside Philadelphia. My father and my grandfather were in the commercial real estate, but construction side of the business. Being GCs and general contractors and mechanical contractors for larger, like, commercial type deals and building schools and Walmarts and, you know, doing stuff at malls and high-rise buildings. So I grew up around construction sites since I was a little kid. And so I've always been interested in real estate, and that's kind of what piqued my kind of where I'm at now. it's been a weird path for me. I would say, it's the ass backwards path of getting where I'm at. I mean, and so, growing up where I grew up, and then I played sports, throughout high school, and I played basketball in college, hence the Rutgers
Are you?
Pursue excellence flag behind me. And then but I guess I went to college to study law. Well, I was a poli-sci major. Then I thought I was going to go to law school and become a sports agent or entertainment attorney. And, I graduated. I had a contract that following fall. So I graduated in May. The following fall, I had a contract to go play in Sweden, professional basketball. And one of my teammates / roommate in college was moving down to Palm Beach, Florida. He had a job lined up, and I'm like, you know what? I'll go down there for summer, hang out, and then I'll go overseas and play ball. And I moved down there the day after I graduated. I was there for 2 weeks, met a girl, started dating her, and her dad was a large developer of high-end residential real estate in a town 12 miles west of Palm Beach called Wellington, Florida, which I had no clue what Wellington was, but learned about it real quick. It's the polo and equestrian capital of the United States. So this guy had taken his money. He was actually just a wealth management guy at a company called Dean Witter at the time. And he knew of an opportunity in this up and coming town that he could buy land and develop it around this small little horse show.
Wow. Okay.
And now that horse show, and you can look it up. I mean, it's probably one of the largest events that goes on for 6 months in Florida.
Wow.
And it's some of the wealthiest people in the world. So this guy, he bought the land. He developed these. Some of the houses were just normal houses, but they'll rent out during season, as they call it down in Florida, for $16,000 a month.
Wow.
So like a basic, 2,000 square foot house. And some of the houses, I mean, his clients were Michael Bloomberg, his daughter Georgina, Bruce Springsteen, Bon Jovi, Sigourney Weaver, Glenn Close.
Wow.
And so these were the people, I got fed to the wolves. I started working for them right away. And he was semi-retired, and he's like, you go to this meeting, these people want to buy this plot of land off us, we're going to develop this house, and go meet with them. And I was like 22. I'm like, oh, okay. And, Bruce Springsteen wants to rent this house that we have for $75,000 a month. Go bring Bruce the keys.
Oh my gosh.
So it's kind of cool. And then you get told off by, I got told off one time, not because of me, but our guys didn't do something that Glenn Close, the actress, wanted to have done. And she, I thought she was studying for an acting role. She was cursing, it was bad. And I called my mom up. It was on a Saturday afternoon. I called my mom up, and I go, Mom, guess who just told me off? So, I worked for this development company for about a year and a half. The whole time, look, I was a young guy. I was making, what I thought was some money at the time. It really wasn't that much, but I was going out every night, hanging out, networking, speaking to a lot of our clients, going to have drinks with some of our clients, and just kind of picking their brain of, Bob Johnson, founder of BT, one of our clients. And, so we had a private club next to the neighborhood, and all these guys were members there, and they would be there at 4 o'clock in the afternoon after playing tennis or hanging out all day, having drinks. And I would just cozy on up, and they got to know me, and I got
Hey, I'm Justin.
So, I mean, this goes to show it's all about networking.
For sure.
So I have a question though about that. So when at some point, I'm assuming the relationship ended. Did that part of your career end as well, or did it kind of still flourish? And
the answer was yes. No, I stayed around for another 6 months.
Okay.
But I used it as a stepping stone, right? I mean, when you're a young person or older person, we're all still trying to find ourselves. So I'm 39 now. I don't know what I want to do. So I try to use every experience and every person you meet, and take something from that and figure out the good, the bad, the better, and keep improving yourself. And so, that was a great experience, just networking and being around all these people, like super successful people. Then during that whole process, I became friends with a guy. He was actually just owned a residential mortgage company, and he networked like a lot of us young guys are doing, gals are doing, and he met a wealthy guy in Palm Beach, and the guy, he had an idea, a concept for a fund, and the guy gave him $10 million to go put out in a lending platform. Wow. And so this guy that I know said, hey, you know a lot of people, you understand real estate. He goes, I have the finance, he has the finance side, and now he has this money. Let's partner up and go out and find deals to put money into. So essentially, it was at that period of time, it was called hard money lending.
Yeah.
Now it's called bridge lending.
It's a softer term.
Yeah. Like, we're not taking an arm and a leg, but we are.
Yeah.
And so I went out. My job was to go and find the deals and make sure that our team was executing. And it was just myself, this one other guy, and we got three girls that were processors from a mortgage company and one from a title company. And so we put the money out. We said, oh, great. We made some fees, and I was sitting there doing my job. My job was, to really originate and bring the deals.
Yeah.
After we put that money out in 45 days, we had no money left for new deals. I'm like, I have $30 million in new originations over here. Like, wow. And a lot of these are good deals. So we went back to an investor. He gave us a couple more dollars, and he said, look, you're on your own. You got to figure it out and go raise more money. Which is not the easiest thing. I'm 23, 24 years old. I didn't grow up down in Palm Beach. And though I know a lot of people, I was nervous about like asking people for money. And so that made me start thinking outside the box. And so I reached out to another buddy of mine from Rodgers that played basketball with me. And he was working in New York City at Citibank on the residential mortgage-backed security and trading and whole loan trading desk. Okay. And we were just catching up, and I said, look, he asked me what we were up to, and I told him. He goes, you could sell your loans. And I'm like, well, what does that mean?
Yeah, right.
And so he explained it to me. I'm like, oh, wow. And we can get a premium for these, like make profit on selling the loans. He's like, yeah.
And do you mind briefly just explaining that to someone? So you have a mortgage, say it's, I don't know, $500,000.
Right.
And then you sell it off at a premium. So like what kind of premium would
and back in those days, we were charging people 9 to 10%.
Wow.
So kind of similar to what people get nowadays. Like if a lot of your listeners might be into the residential fix and flip business, and maybe they can't go to their bank, or they need to take down a house because it's a hot market and they don't have 90, 120 days wait for their bank to close on a mortgage for this investment property. So you go to a bridge or hard money lender, and they'll close in 7 days, but they'll charge you 10, 11, 12%.
Yeah.
Same thing. That's what we were doing, but it was just back in 2005.
And the bank will make it up on the interest anyway, right? So you're
So what we were doing, we were originating.
Yeah.
I then through my buddy, he connected me to a couple of banks and a couple of private equity funds that buy these mortgages off of other lenders.
Yeah.
And because their cost of capital is super cheap, so they can make a spread.
Yeah.
Like a large spread. Yeah. And so we were getting 3% on the back end, 4% on the back end. Okay. On $10-15 million a month. I mean,
that's
another 300 grand.
Yeah, right.
And which we would split with our investor. So it was real money.
Right.
So that's how I got into like the loan, kind of the finance side and the loan trading side all at the same time. It was all on the job experience, figuring out, being a young guy as you go and just hustling kind of. And so that was going really well for us. We were kicking butt, making a good amount of money because I can, as fast as we would put that money out, we would go and sell the loans off at maybe twice a month, and maybe we'd do 30 million that month in deals. So it was a lot of money. I was having fun in South Florida. So
and then selling it back to the banks for 3 to 4% commission is essentially. Got it. No, that's a great way to start out.
We're doing that. Our investor loved it because he was a wealthy guy, not in the real estate business, but he's like, holy crap, I'm making teens type of returns. Actually more than that, because we were turning the paper the loans every month. I mean, he's making 2-3% a month.
Right. That's
phenomenal.
That's
really good, right? And it's just for him to diversify from his normal core other investments and business. If you have $10 million to give to a bunch of 20-year-olds, now you're only 10 million,
right.
Or your last 10 million. So that's kind of how I got involved in the finance, and also on the lending and loan trading side. We started to see the world changing in 2006, end of 2006 to 2007. It was getting harder and harder for us to find good deals. That 65% LTV that we were lending at, we couldn't find deals at 65%. We were having to go up to 70% and 72%, and which adds more risk to you, as. And we knew that there was going to be a large foreclosure issue, coming up. We didn't know when. We didn't know how many properties were going to foreclosure. So if you remember back then, there were so many people buying properties, especially in like California, Florida, Arizona. I mean, you could get 100% mortgage, but no money down, and you. Oh, I'm on a podcast here. Sorry.
Yes.
And so
that's the work from home life.
Exactly. And so you can. It was just a really cool experience and learning experience, and being kind of more on the entrepreneurial side of things, not a corporate type job. When at this point in time, I was making great money. I was doing this fun stuff, and all these other guys in the business I'm in now were like going the proper route, where they go to college, they get an analyst job or something right out of college. Then they do that for a year or two, and this is like the New York City private equity, hedge fund. Like, this is the route that that these people go, and then they do a year or two at XYZ bank or fund. Then they go back and get their MBA. They get their MBA from whatever school, and then they come back into the work field, and they're 28 years old, but on the right path, and networked in the business school and all that. That's kind of the route that is normal I would say, in New York City finance. I didn't take that route.
It seemed like it worked out well, right? So that was kind of like your version of grad school. And your boot camp, right?
It was boot camp and school of hard knocks. But it also kind of, to me, showed that everything's on the job experience at the end of the day. Not anybody, but if you have common sense and you don't really cut corners, but you're willing to listen and try to learn, anybody can kind of, especially you can do it when you're younger, when you don't have kids, and take risks. Right. Your life changes a little bit when you have responsibilities and like kids and family and things like that. So 2007 hit. We didn't like where the world was going. That the pricing for us, the people, the banks and funds that we were selling to, they were coming to us and saying, look, we're not going to pay you 3-4% for those loans anymore. That 9 or 10% that you're charging, you have to start charging 12%, and we're going to pay you 1% on the back end. And we're like, the world was just getting weird. And so we didn't like where it was going. And we decided to frankly sell off all the loans, return all capital to the investor. And I went to go, there was a group that was actually trying to raise a $100 million fund for us. We said, the world's changing, the lending, it's getting scary out there. And again, this is also 2007. And they said, why don't you come work for us? You know the loan sale world, you know the finance world. We're on the commercial real estate side. Come over. And so I left on a Friday and started on a Monday.
Wow.
Called the Carlton Group, which is a fairly large international real estate investment banking firm, but boutique style. It was owned by one individual, a guy named Howard Michaels, who's in New York City and around the U.S. on the commercial side has a very big reputation. Ruthless guy, didn't take any crap from anybody.
Yeah.
Had no problem telling the clients, what he felt.
Yeah.
And he was known for, churning and burning employees, and, they would come in and you'd bring a database of, all your investors, and 2 days later he'd fire you and say, I have your database, I don't care.
Yeah.
But he's in New York City at the time. He passed away a couple of years ago, but he was one of the big guys doing $1 billion finance transactions and $500 million finance transactions, and personally making $20+ million a year.
Right.
It was pretty cool to watch him. It was, so I went to go work in the Florida office, end of 2007, 2008. 2008 really hit. You get, Lehman Brothers and all these other, and Bear Stearns and all these other companies going down, and it was a scary place for a lot of people. And the foreclosures started, and people were losing their jobs. It was a bloodbath.
Crazy. Yeah.
I remember sitting watching like CNBC one day, and Goldman Sachs stock went from like $140 a share to $60 in one day. It was like,
Yes. Good.
yeah. So I said to myself, what do I do? This is like, I'm in my 20s still. It's kind of that inflection point. Like, do I want to stay in this business? I don't know what the hell's going on in the finance world, and nobody knew. Yeah. Do I try something else out? And so I decided to move up north. I said, there's nothing going on in Florida. There's at this time, there was no financing anywhere. Yeah. And I still had the loan. I was still doing some loan sales, which was great money. So at this time at Carlton, and I apologize, I skipped the step. So what I do now is what I started doing in 2007 at Carlton Group. And I guess I'll lead into, here's what I do. I'm a partner at Avison Young since 2012. So going on 9 years this January. Avison Young as a firm is a global commercial real estate firm, similar to a CBRE or Jones Lang LaSalle, or a company called Eastdil and Cushman Wakefield. Those are our competitors. Okay. My team focuses, but we're a little different. Most of those guys are publicly traded companies right now, and we're a privately held company. So we're kind of set up. It's a Canadian firm. We're set up as a partnership. Basically, it's us partners, right? It's like a law firm where you have partners. You have some C-suite people, like a CEO and president and CFO and all that, but the partners, everybody kind of has a say, which is pretty cool. And I joined the company in 2012. We were the 5th U.S. office. I was the first person hired in New York. We now have 150 people in my office in New York, and we have, I think it's 124 offices in 16 countries.
That's awesome.
And it's not our growth hasn't been by hiring Justin, and he's sitting in his house, and he's our I live in New Jersey right now, but commute into the city for work. Justin's our New York office, but he's working out of his garage. That's not how we've grown. It's been through acquisitions of other companies. So we acquired a company 2 years ago in the UK called GVA. GVA is a 150-year-old commercial real estate company, and we bought them for 400 million pounds. Wow. We bought a company in Seoul, South Korea 3 years ago. It was a spinoff of Samsung's real estate group. So we just acquired a company in Israel 2 months ago. So it's been like real growth and acquisitions of companies. I I run the New York City finance team. So what do? Core business is raising capital, LP equity, co-GP equity, mezzanine financing, which is like for up and coming real estate investor, like a second mortgage.
Mhm.
But instead of calling it a second mortgage, which you would have on a residential property, mezzanine loan is a second mortgage on a commercial property. Pref equity, which is similar to mezzanine loan, but you use it in different types of transactions, and it looks more like equity than debt. And then first mortgages for real estate developers, investors of all asset classes. So I started doing that on a larger scale on the commercial side in 2007, and I do it to this day. Secondly, I'll get real quick through it. Secondly, trade performing and non-performing loans, which I started doing in 2005 on the performing side. Mm-hmm. Up until 2008, 2009, it was all performing loans. Then the last downturn hit, everything went non-performing, and I just started calling all the banks that I was already working with, saying, "What do you have that's non-performing?" Yeah, and I've done some large portfolio transactions. Ocean Bank in Miami, I sold $400 million of non-performing loans for. Capital One sold $350 million of non-performing loans. So I've continued to be in that business. And then thirdly, I raised lines of credit for family offices and private equity funds in the bridge lending or loan buying space. So, that old company that I worked for back in the day doing the lending, I'll go to, if it was around now, which is like 15 years later, and they're managing, I don't know, $100 million or $1 billion, I'll go out and get them a line of credit from a bank so that they can use leverage to boost their returns. No different than you guys as a real estate investor would use leverage to boost, not have to put out as much cash, right?
Right.
So that's what I do.
No, that's awesome. So people listening, if you're interested in real estate, a lot of times, people jump into flips and they get started that way, or like they may be a real estate agent. If you're interested in the financing stuff, it doesn't always mean that you have to go to a top MBA program, as Justin mentioned. Some of it is, hey, you start small with who you know in your market, and you get creative on financing deals, possibly on the loan side, the mortgage side, and short-term financing for folks. And then just build your career that way. If you feel like, traditional school route is not the option for you, I think this is a huge success story and proof that there are alternative ways to play in real estate and play big without having to go the traditional route. So thank you for that.
Yeah, I mean, look, to give people confidence, like a lot of people go to college and they take on a lot of debt and all that, and then they end up, what do you end up doing? You get a job and then you become a real estate agent. Well, why not just get the real estate license at 18, 19?
That's right there.
Maybe you go to college, but you're doing it on the side. I know a number of guys that are very successful in their 30s and 40s now that in college, they were making like real good money, being like rental agents in New Brunswick where Rodgers is, or in Philly down by Penn or Temple, and doing rentals. And doing that type of stuff. Get started as young as possible. I know a lot of guys didn't go to college and they just went right into real estate, and now they
doing well. Yeah,
they're kicking butt. So I mean, I don't know. Some people, I'm not an academic, so like I think college is a little bit overrated, and I felt insecure for a number of years in my 20s because I didn't have that analytical background and of financial modeling, and I didn't become an analyst at Apollo or Blackstone, but I've hired a lot of those people, and I still continue to hire a lot of those people. And I hire kids. I have a kid working with me that went to Harvard, and he's an analyst for me, and he's kicking butt, and he's great. But I know what my skill set is, and my skill set is, and I focus on it, and then you fill in the blanks as you get older, and of building out your team of what you're missing, right? You can't do everything, so I'm good at originating deals, and I'm good at knowing where to figuring out who's real and who's not. Which is a big thing, whether it's on the client side or on the lender or equity side, and I'm good at placing the deals. And you know what? That analyst and those guys, they don't have a job unless I'm bringing in deals and making sure that the deals get done and money's coming in. So I played an important role. It's a little backwards, but have confidence. Try different things out. But if college is not for you, you don't have the money. Spend the money wisely and go get a real estate license or a mortgage license or whatever. It's all on the job experience at the end of the day.
For sure. No, that's great advice. Hopefully the right people hear that message and they can decide. Some people it does make sense. Some people it doesn't, and you figure out what works for you.
Right.
You've kind of talked about capital markets and what that is. So can't you jump over and talk about the trends?
Yeah, definitely. What capital market trends have you seen since the pandemic, and how does capital flow today compared to a 2019 pre-pandemic commercial real estate environment? And can you provide insights on how you perceive overall investor appetite?
There's a lot of money out. Well, so I'll answer your last question first. There's a lot of money out there. Whether it's high net worth families, individuals that are at somewhat retirement age, but they've been very successful business people, private equity funds. There's just a lot of money that's been sitting on the sidelines, I would say, since March, right? March, April, May, people are trying to figure this whole thing out. Guys and gals are working from home. Business people aren't traveling. You can't get on a plane and go look at a property if you live in New York and the property's in, I don't know, Georgia, or nobody wanted to do that.
Right.
So I would say pandemic has caused a lot of uncertainty, and uncertainty is not good for any type of business. You want confidence, right? People want to be confident that what they're going into is a good investment, and they're not going to lose their money or their investors' money. Because if it's investors' money, you get fired. If it's your money, your wife leaves.
Exactly.
Or your kids are pissed off at you one day. But you also have to live and learn in business, and sometimes losing money on your first deal or two, it's going to happen. So, I mean, look, I would say on the lending side, banks are super, super conservative. I mean, if they were lending to, if I was going out getting a mortgage on trying to think, like a rental building, I wanted to buy an 8-unit property. And if that bank was lending at 65% loan to value pre-COVID, they're at 55 or 60% loan to value now.
Wow.
Just because, there's a lot of uncertainty, who are the tenants? Are they in the restaurant, or are they bartenders? Do they have jobs, or, will they have money coming in? I would say on the multifamily side, because a lot of your people probably are on the residential, rental, they own a home and they rent it out, or they maybe have some small multifamily properties. Who are the tenants? And so the bank or a lender has to factor in that risk that person might not be able to pay. Obviously, the first stimulus was helpful because everybody thought that most of I would say collections around the country were in the mid 90% through, I would say, July. It has now started to dip again because people didn't have that extra money. People that got laid off, some of them were making more money, and it was
stimulus.
I mean,
unemployment.
And that $600, and then if it's you and your girlfriend, or you and your wife, or whatever, and you're both laid off, and you're getting extra, about $1,200 a week. I mean, that's more money than some people had at any given time. And so, and they didn't want to go back to work because they were making more money sitting at home. My aunt's in the casino business. She's CEO of a casino down in Biloxi, and she said we were making money hand over fist, and we couldn't figure out where the money was coming from. And when they opened back up, and I said, well, unemployment. She goes, she's like, yeah, people have for
Free
more,
money.
yeah.
Yeah, free money.
Yeah.
And so it'll be interesting to see. I mean, so the moral story: the banks are more conservative. I have a lot of deals right now. I mean, clients are very, very wealthy, and they're trying to do new acquisitions of properties. And banks that should be the go-to lenders in New York City for a multifamily property are saying, we're not going to lend. It's not an existing client. We're not going to lend to them.
Wow.
Yeah, it doesn't matter who you are, what it is. They are being super conservative.
Wow. As you're talking, I'm like taking notes. I find that super interesting. I wasn't aware. I knew that they were conservative, but I didn't realize how tight everyone still was.
Yeah, that's where the private equity funds and the bridge lenders and all these guys, they frankly, since the last downturn, they filled the void.
Yeah.
The banks became more conservative after the last downturn, and all the Dodd-Frank and Basel II and III regulations, and these are all things you could Google, but it's kind of a checks and balances system that Congress and Senate and the government put into place for the banks, so that we don't have a meltdown like we had 10 years ago, back in 2009, 10, and 11.
Right.
So they made a lot of the rules stricter for banks to lend, especially on construction deals. And so with banks being more conservative, the private equity funds kind of have filled the void. And yeah, they're a little bit more expensive, but if you're a developer, your biggest enemy is time, right? If you don't get that thing built, you have a hole burning your pocket of, you're paying a loan. So you want to get the property built, leased up, and so stabilized, and then get some cheap bank long-term 5-10 year money, from a bank at nowadays 3%, we'll say.
Right.
3-4% I mean, I've seen multifamily properties, guys getting the larger side from like Fannie Freddie, 2.5%.
Wow.
Which is like, it's free money almost.
Right.
Yeah. So that's after like stabilized, right? That's like once you've done the work, the renovation. Yeah.
So, but being a developer, you have to get that thing built.
Yeah, definitely. So with that said, I don't know that there are short-term real estate wins considering private money. There's still opportunities, but are there any short and long-term wins that you see? And then are there any properties or property types that are currently undervalued or that investors are starting to take advantage of? Or do you think because of, like you said, the stimulus and federal aid, that is still maybe too early to see the discounts and the distressed assets caused by COVID?
It's too early.
Too early? Okay.
Yeah. I mean, what's happened from March through now, let's say you're an owner of, I don't know, a hotel or an office building or multifamily, and you're having issues. In many cases, you've gone to your bank and you said, hey, here's my issues. You're communicating, which is key. If you borrow money from somebody and you owe them that money and you're having issues, don't just disappear on somebody. That's the worst thing.
Definitely.
Bad things happen. People want their money back. But if you communicate to somebody, it's like, and the most basic term is like, don't sucker punch me. If you're gonna punch me, just let me know you're gonna punch me first. Right?
Yeah.
Lenders want to know that that you're having issues, and they'll work with you. And so there's a thing called forbearance agreements that a lot of lenders have done since March, April for people, and this is on the commercial side, but also on the residential side. If you lost your job, you can call up your bank, and no bank wants to have negative headline risk that they're putting somebody, hurting a family by kicking them out when they lost their job because of COVID, right? And so they'll put you on a forbearance agreement, and basically it's kicking the can down the road. You don't have to make a payment or make a partial payment, what you can afford to pay, and we'll just tack it on the mortgage payments on the back end of your loan. So we'll extend your loan if it's, I don't know, a 5-year loan. Now it's you'll have that loan for 5.5 years, or as long as your forbearance agreement was. But banks have done, and they usually do it in 3 and 6 month increments of what we've seen.
Yeah.
But if you're on 2-3 month increments of forbearance, going back to April or May, it's October now.
Yeah.
Right.
And the banks are saying, all right, we got to figure something out. We have to come up with a plan here. What are you going to do?
Yeah.
And so a lot of the distress isn't there because guys that are actually have underperforming assets, they haven't got foreclosure notice yet or put into default because banks have kicked it down the can down the road.
Right.
Got it.
They don't want the bad press.
Yeah, but it's now that you're 7 months into this whole COVID crap. Let's be honest, it sucks for everybody. Even if I've been doing well, I've been making money, but because clients don't know where to go, but it still stinks. I mean, I've lost a lot of deals that I had hotel deals that clients were buying hotels in February. They were only closing in April, and they backed out of the deal because nobody's traveling. Hotels are boarded up. I mean, it's a horrible, horrible thing. And so certain asset classes, hospitality, hotels, they're a lot of them are screwed. In major city centers like New York City, Broadway's closed through May. People aren't coming in for shows, no sporting events, no concerts. New York is a live, work, play type of environment, and you can't play. I haven't been to my office. I went to my office once this summer. I haven't been there. I've been there once since March to New York City.
Right.
I think the number is right now about 15%. So 15% of workers in Manhattan have actually returned back to their office.
Yeah. We were talking about the office space and how that will be impacted. A lot of people are talking about lodging, of course, beat up in terrible shape.
Right.
And eventually people will return to the office. I don't think it's going to be as dramatic as some people are saying, but short term, I mean, to your point, the forbearance, it's coming to an end. People have to figure out what to do. Meanwhile, tenants still aren't returning to the office. So that's a real problem. So while you're saying, it's too early, are there asset classes that you think will have be impacted more? And like, what success stories do you think, if someone at the right time can go in, what property types should they be eyeing that will win long term as we get out of this pandemic?
Yeah, I mean, I think multifamily, there will be issues in different cities and states. I mean, New York City, for example, they have a big problem with multifamily, and it hasn't been addressed since COVID. But due to the political landscape in New York being very on the left side, they passed all these rent regulation, rent stabilization laws, not this summer, but the summer before, so a year and a half ago. Overnight, with those laws, it was like a punch in the face to landlords, and they lost 10 to 30% in value overnight on their properties.
I saw like 6 and 7 caps in within days. It was crazy.
It's nuts, but it's a scary thing if you're an owner of a property, because all the laws can change on you overnight, and you can be screwed. Like,
there's nothing you can do about it.
Yeah. So I mean, you guys are investors, and you're buying. Let's say you're buying a multifamily. Well, you're buying that multifamily that's not stabilized, right? You're buying a multifamily that has some hair on it, and you want to fix it up. Go into the, put some lipstick on a pig, as they say, right? You paint the outside, you pressure wash it, you clean it up, you go into the hallways, you rip up the tile, and you make it nice. You go into the room, each unit as tenants move out, and you put new kitchens, bathrooms, and floor. And then when you rent that property, that unit back out, hopefully you're getting $100, $150, $200 a month more. And when you have multiple units, it adds up, right? That's a value add type deal that you guys are looking for. Well, in New York City, with the new laws, they said you can do that, but you can't increase the rent. So you're throwing good money on top of bad.
So it discourages everyone from doing that.
You don't get credit for putting $10,000 into a unit. You're stuck at the old rent. Right. So the problem with that, it's short-term thinking. Yes, they're trying to help people out, right? There is an affordability issue for housing across the country in every major market, 1,000%. But they didn't. The problem with New York, it's being run by people that aren't business people, right? They're just pandering to whoever complains. But it's a trickle-down effect. Now landlords are not. You know what they're doing when somebody moves out? They're locking the door and just letting it sit, and hopefully 5-10 years from now, the law changes back to something normal, or happy somewhere in the middle.
Yeah.
But their buildings are going into disrepair. You're gonna be walking down the street and you'll see more and more stories of somebody dying because a brick crumbled off the building because they didn't fix anything, and it hit some poor lady walking with her kid.
Yeah, because the landlords. I was gonna say the landlords have no incentive to fix anything because they can't recoup that money.
Right. So yeah, go ahead, Mark.
I was gonna say, and that's just a function of not bringing all the right appropriate parties to the discussion when thinking about how do we solve for affordability. You're only bringing in several parties, but not the owners, and then you slap this law down, and now owners are like, well, I didn't have a say in any of this.
Yeah, I mean, and who's paying all the taxes in the city?
Right. Yeah.
Landlords, right? Big office owners and the owners of the building. That's where most of the taxes come from. Right. And when you get like a young person like AOC coming in and she's trying to do a movement, right? But she has no business experience, right? And there wasn't like, hey, let's meet in the middle, let's talk.
Right.
Here's my concerns. What are your issues? How can we do this? It's like, screw Amazon, screw the landlords. I'm not taking any money from the real estate owners. But now New York City's a complete mess. So opportunity in New York, a lot of people are running away. They're going to Florida. I'm done with the city, they say. And they're going to Nashville and Dallas, markets where you don't have state income tax, right?
Yeah.
It's favorable for business. Corporations are going there. Quality of life is cheaper. You can buy for a couple $100,000, and you could buy a 5-bedroom house, and compared to New York, you get for 800 square feet, you got to pay $2,000 a square foot for like an okay place. That's what, $1.6 million to $2 million for 800 square feet.
Right. It doesn't make sense.
Doesn't make sense, and it's high taxes.
Yeah. That's why we've been focusing on Dallas, looking for opportunities in Dallas and Atlanta. To your point, though, people, owners, sellers still want that pre-pandemic valuation, and we're just like, man, when does this shake out? But we have to get through. And I know you'll talk about politics and election, but I'll just jump right into that and start to skip on you. But since we're on the topic, a lot of people right now they're taking a step back and saying, well, let me see where this election shakes out, right? Because it's two total opposite sides of the spectrum. And one is more pro-business, other is who knows what Biden, because it's not really Biden, right? There's what's going to happen a year and a half from now. He gets elected, they'll say Joe's a nice guy, but he has Alzheimer's, dementia, and who's really running the show on that side? And they'll have to raise taxes, and what's going to happen to the business people, and there's a lot of uncertainty. But I saw a stat. We did a webinar the other day, our New York City office, and they had a graph of every election year that the amount of investment and leasing and everything goes down every time there's an election, just because there's all uncertainty. So it's a lot between now and year end. You get the election, and then it's Thanksgiving, and then it's Christmas and New Year. Like, if you're not getting a deal done, or signed up right now in October, it's gonna be really tough to get something done by year end.
By the end of the year,
And what's gonna happen? The banks, they'll see what their issues are over the next few months, and by, I would say, end of first quarter, second quarter next year, you'll start seeing distress. You'll start seeing opportunities. Landlords owners are going to be losing their properties or turning back the keys. There will be opportunities created, as sad as it sounds, right? That somebody has to give back their house or their investment property or whatever. It creates opportunity for other investors. up and coming young investors like the three of us, right?
Yeah.
This is where, times like tough times is when a lot of people have made fortunes or started to make fortunes and built from there. So,
and I'd argue too, on the positive note, in addition to finding opportunities as younger investors, if you get it at a decent price because it is distressed,
right,
you may not have to push rents to such a premium. Maybe you create more, back to your point on affordability, maybe now you have quality units in these value adds where you don't have to, keep putting stress on tenants because you bought well, right? So
it's not just bought well. Go back to interest rates, right?
Yeah, and rate, cost of
2
capital.
years ago, that rate might be, the previous owner might be paying 5.5%. You might be paying 3% now.
Yeah, very
that
true.
Helps you. It trickles down to the tenants as well.
Absolutely. So that for the last question, Kent, that kind of ties into what we're talking about. Timing. Yeah,
definitely. So if you were an operator, if you're on the operator side of the business, particularly a small operator, what sector or geographical region would you focus on that could potentially result in easier investor capital flow to finance projects?
That's a tough one. I mean, look, I work in New York City, and a lot of my clients are there. I wouldn't invest in like New York City right now. There's just too much politically. There's too many rules that can go against you and can hurt you, especially as an up and coming, younger investor. You want to you're taking risk already, but you want to mitigate that risk, and you don't want to have somebody from the outside totally screwing your everything and your dream, right? Because maybe in the beginning, like, you have limited capital, and you need that first deal or that second deal or the third deal to move to the next level and to the next level. So, you got to be a little bit more conservative. Everybody keeps saying the Southeast, like all these New York guys, they're running around Texas and Atlanta and South Florida. I mean, but you have to know the market, right? I think there's opportunities in any market that, where people live. You just got to hunt for them. Don't always jump at the first deal. I mean, as a beginner investor, frankly, maybe partner. Here's what I do, right? I've tried buy the residential properties myself and run it as a landlord, and also try to be a dad and have my job, and it's a nightmare. I mean, there's issues, there's complaints, there's this. You have to get stuff fixed. That's not for me. And what I've started to do, because I'm in the world and I'm familiar with the platforms, but there's a lot of these crowdfunding platforms out there. Well, one example is a company called crowdstreet.com. I've invested in 4, 5, 6 deals on CrowdStreet, because everything's on your computer. I can see who the landlord is. I see what their debt is. Like, everything's right there, and I don't have to put $100,000 into it. And I don't have time, right? I have 4 little kids. I have to commute to the city. I'm trying to do my regular business so I can keep making money to reinvest in deals. I don't have time to go paint walls and lease the property out and listen to some guy's issues, and I don't have time for it. And it's not the best use of my time, because I need to be trying to make money.
And to your point, I would say if you're a newer investor listening or a part-time investor, to Justin's point, there's instead of putting all of your savings into one project or trusting one contractor to do a flip with all the things that could go wrong, you could be spreading your money either through REITs and REIT ball, like we've been saying, with the transparency, or also the transparency of these marketplaces where you can put a little bit of money across several projects to mitigate your risk and have the transparency and have someone else do it so you can sleep at night, have some cash flow over time, and build wealth that way.
And look, everybody wants, I want it right now. I want to, everybody thinks they're going to go in, they're going to buy something, they're going to fix it up over 30 days. They're going to have it flipped out in another 30 days, and they're going to make 100,000. It doesn't work. that's
definitely
worked.
doesn't work that way.
There's 10 million people that it didn't work that way.
Right.
I can tell people specifically it does not work that way.
So, the way, and I've learned this from a lot of older wealthy guys, that were developers that started small and then became billionaires or worth a lot of money, a couple $100 million or whatever it is. And what they do now, they're like, I'm tired of developing. I'm tired of dealing with all the permits, approval process, the issues, the contractors. I'm done with it.
Yeah.
I'd rather put my money into find somebody that's real, put my money into their deal. A development project, for example, like I've invested in a couple multifamily development projects this year. Though, COVID's going on and it's a scary place, you know what? That project's not going to be complete for 2 years.
Yeah.
Right. If we still have COVID and we're dealing with all the same issues that we have now, we're as a country or world, we're totally screwed anyway.
Right.
We still have the same issues. So, I'm willing to place my money into a deal with a company that owns 500 million or $1 billion of assets. So they obviously know what the heck they're doing. They're getting really good financing, and I'm putting $25,000, $50,000. You can just do smaller increments. Yeah. I mean, that sounds like a lot of money to all of us, it's a lot of money, right? But if but it allows me to free up my time. I'm putting my money into their deal. Maybe I'm looking for deals where I can get a 2 multiple and a 20+ IRR. So the only place you really don't get that is on development deals or value add, like super value add deals, right? Mm-hmm. But if you put 25,000 up, and 3 years from now I get that money back at a 2 multiple, that's what, 75 grand now in my pocket.
Yeah, that's a win.
And then you 1031 it, and you put it into the next deal. Mm-hmm. So now you have 75,000. Then you shoot for the same thing. Yeah. So 6 years down the road, after that 25,000, hopefully you have 250, 300,000, right?
Yeah.
And you just tax free.
Yeah, to your point, that's getting harder and harder to find those new. Development is obviously the way to go. It's getting tougher, but for sure there is opportunity out there. And like you said, with the right expertise, find the right partner to invest in. Don't just invest in anyone, please.
Yeah.
Make sure that they know what they're talking about, what they're doing.
Yeah. I've learned this. Don't do it with friends.
Yes.
Like Mark, guy or two that I think a bunch of us have lost money over the years with them.
Have you also? Well, this is off. We'll have another separate discussion outside. Yeah. Hopefully, it's not the same people.
Yeah, you live and learn. But that's why I'm utilizing like a platform. Whether it's I invest directly with a client of mine that I'm raising money for, and I know everything about them and their net worth and where all the skeletons are hidden, or through a platform like a CrowdStreet, Realty Mogul, ArborCrowd.com. There's a couple of these that they're only touching really successful investors and development companies, not some guy that down the street that used to play basketball in Europe and he has 250,000 and he had 2 fix and flips that he did well on, and I've been pitched by teammates and buddies, and I'd rather keep them as teammates and buddies than
for sure.
I know more about the business than they do, and no,
that makes sense. So
and one other thing, Mark, it frees up my time. It allows me to continue to do my day job and not be able to sleep at night, know that the deal's there. And the way I look at it, and I told my wife this, every 25,000 that I invest into one of these deals, I envision that at some point in the next 20 years, becoming $1 million. Mm-hmm. So if you take a lot of 25s and you do it, and nothing ever works properly, but maybe it takes 30 years, but I'm building something for my kids and doing it through like the proper channels but it allows me to do my job because that's where my cash flow comes from. Right. I'm not relying on that as my cash flow.
Right. And that's most important for everyone listening. You can't just bet on one investment as that's going to be the thing to keep you afloat. you have to have multiple income streams. A core one that's coming in from your day job, and then, think about the investments through, some of the options that we discussed today. So Justin, I want to be mindful of your time. Do you have a few minutes for the most important part of this entire show, which is sports? I know you have a sports background. Do you have a couple minutes for us?
Yeah, let's do it.
All right.
Awesome. So this is good, man. So Justin, as you heard, he's played ball all his life. He's an athlete. He's a sports fanatic. So I'd love to hear his insight.
Used to be an athlete.
Well, since the NBA ended, then my Los Angeles Lakers are the new world champions, raising the 17th banner.
You got a lot of front runner jerseys there.
Exactly. Those are my squads. Those are my squads. But we'll hop into NFL since that's going live right now.
Yep.
And let's take a second to try to separate the contenders from the pretenders. Now that the Bills have lost, you have 4 teams that are currently still undefeated: the Steelers, the Seahawks, the Titans, and the Packers. Who do you think's real in that group and could take it all the way?
So I'll start with who's not. I don't trust Pittsburgh.
Okay.
I mean, Ben's been there and he's won Super Bowls and everything, but he's one hit away from getting hurt and being out for the season, and what they have, right? So I don't trust them. Russell Wilson, Seahawks, they have stability. They've been there for many years. You can't knock, and they're like a well-oiled machine right now. So you got to watch out for them. Who else we got? The Bills, you said, or no?
We got the Bills lost, so we got the Titans and the Packers.
I like the Titans. Coach. He's a young guy. He was a successful player. Played under Belichick. Coached under Belichick. He knows that secret sauce. Yeah. A guy like Tannehill, who he was the number 1 pick, I think, for the Dolphins at some point, or top first round pick, and he sucked. But he also had injuries. They were a horrible team, and as you guys know in sports, sometimes you just need the right system and confidence, right? Yeah. I mean, this guy looks confident right now, and it helps that you have Derrick Henry just trucking people and running.
Right.
Exactly.
But they also have a good defense.
Yeah.
So they were there last year.
Yeah, they were 1 game out.
So I mean, you can't.
I think I saw.
I don't trust them to go to the whole thing. I think if it's them in Seattle, I would pick Seattle over them probably. But I don't know.
Yeah, Seattle was my team, and then second would be Tennessee for sure. The Steelers just always seem, and I have a couple buddies who are diehard Steelers fans every year, and I'm an Eagles fan, so I guess I can't talk too much. But but we did get our 1, so I'm okay. But yeah, every year the Steelers kind of seem to just not put it together, from injuries or otherwise.
Something happens. Yeah. Something happens. So you guys are rolling out A-Rod. No one mentioned that. I said nobody mentioned the Packers.
So that was the 4th team, right? I don't think he has enough weapons. I mean, he's overly confident, that guy, and he's always been successful. And I don't think he has all the right weapons, and they could be 1 injury away from falling apart too.
I mean, to their credit, Devontae Adams he's already missed 4 games, and they're still undefeated. So it's going to be interesting to see when that team gets healthy, what can they actually do? Is Aaron Rodgers still Aaron Rodgers? He had a soundbite the other day that said people need to understand that my worst season is compared to people's best seasons.
Yeah, I saw that. All the monitors were like, oh.
Right, yeah. I mean, and it's crazy because I don't think anyone else could get away with saying that in any other sport.
No, I mean, LeBron can, right? And
I guarantee if LeBron said it, you'd have 1 million people that have something bad to say about it. So.
Oh yeah,
yeah. Aaron Rodgers is actually my favorite quarterback, so I'd love to see the Packers do well if the Eagles can't. But I don't know. I think Seahawks still strong, still are the strongest of the undefeated. Hey, Kent, for the sake of time, could you wrap up the LeBron and Tom Brady? I just need to know Justin's answer there.
Yeah, we had a poll that we had going on. Who do you think is most dominant in this sport, LeBron James or Tom Brady?
The question is dominant, right?
Mm-hmm.
I would say LeBron, but look, Brady in that system, because it's all about the Belichick system, right?
Mm-hmm.
We've seen 3,000 wide receivers, 3,000 different running backs. Their defense is traditionally consistent, with all the good Rodgers guys that we have that are on the defense, McCourty brothers and Harmon and a bunch of those other guys. But that offense, they've interchanged guys going back to Randy Moss and all Welker and like all. I mean, it's about the system, right? So, I mean, Tom Brady. I don't think as a young quarterback, if he was with another team, he'd probably be around for 10 years, but he'd be a backup quarterback for 7 of them, like a Fitzpatrick or one of those guys, right? Wow. That being said, he's won 6 Super Bowls and he's Tom Brady.
Yeah.
But being totally dominant, LeBron doesn't need, won't go there. He can take over a game himself. Tom had to like kind of rely on others.
I used to think that, and then the moment you say that, you see Tom take over a game.
That's true.
So I've seen both sides. I mean, Patriots were down 28-3. That's not defense. That's Tom Brady.
That's true.
So I agree with you. I think football is always going to be the more team sport. You're gonna have. I mean, one person can't take over a football game all the time. To where basketball, you can go out and score 40 points every night and win a game.
Bigger question for you guys is, I'm flip this on you. I'm asking the questions.
Definitely.
Le'Veon Bell, Chiefs.
I like it.
Sure.
I don't want to see the Chiefs win again, but I like it for Le'Veon. He's on a contender. I think
he could be the reason why they don't win. He could just blow up a good dynamic and be a cancer to the team there.
He could, but that team works. I think, like I pictured him on the Chiefs. I pictured him on the Patriots because those are
the Patriots.
Those are 2 teams that will take those chances.
Right.
Seattle as well. Pete Carroll has worked great with people that nobody else wanted to work with. Yeah. So I like where he's at. I don't think the rookie out there, he's been playing well. I don't know if he's got enough touches yet. So, but I don't think Chiefs game plan changes that much, but I think they're much more deadly. I mean, you could throw Le'Veon in the slot. So it all depends on who stays healthy. But I think Chiefs are obviously the favorite, and I got Seahawks coming out of the NFC. I think Russell Wilson is on pace to get his first MVP. It's crazy that he's never had one. But
he did. No,
he has no. I don't even think he's ever finished top 3 in voting. It's something like a ridiculous stat that he's never been close, yet he outperforms people every year. So I'm excited to see how this unfolds.
Well, maybe Future will make another song about him.
Exactly.
Hey, well, Justin, hey, you gave us 11 minutes over, man. We're super grateful to have you as a guest and to have you stay extra minutes.
Yep.
We appreciate all the information that you provided. And then for the listeners, we'll break it down for some educational opportunities to just go over what Justin covered today. Again, Justin, we're thankful. Thank you for joining REIT Ball and for sharing all that you know with us today.
Yeah. No, and if any of your listeners have questions, send the guys, an email with your questions. Guys, get it over to me. Love to help people out. If they have any questions, if anybody wants to contact me and pick my brain, I do a lot with Rutgers University. We actually the school started an MBA program for real estate a couple of years ago, and so I speak to a couple of the classes, and I give out my business cards, and these guys and gals, they'll call me up because everybody's trying to figure out life, right? I mean, career, and it's scary out there in the real world, right? But it's also can be fun.
Yeah, absolutely.
So
and like your guidance, I'm sure people will appreciate it. So definitely we'll reach out and try to connect in the future and just kind of keep the dialogue going.
Sounds good. Thanks, guys.
Yeah. Thank you.
Right, thank you. Have a good weekend.
You too. Take care.
You too.
So we're back. You got any final thoughts for everybody?
No, I think it was a lot, and I think it's a lot of great information, and I think it's a good time to really break down capital stack and financing and some of the things that Justin talked about, because it does relate to REITs when you're looking at analyzing different REITs. What has a lot of leverage or more debt versus less debt, and we talked about it several times during crisis or pandemic. The folks with less debt typically can survive the storm and kind of come out of it on top. So there are some interesting elements that he covered with mezzanine and equity and debt. So I'll make sure that I do a separate episode where we break down the different modules on financing. But I mean, Justin was great. He brought so much as far as his background, his career, different opportunities to think about if you're interested in real estate on the professional side. Different things to think about on the investment side so that you can protect your capital while diversifying in real estate. Any final thoughts for you on either the interview or sports before we wrap up?
I loved everything we talked about. I love his perspective as far as different routes you can take to get in real estate. There's no one single way to go. He happened to go on a date and everything came after that. So everyone, do what works best for you. Always read the fine print. That's always my advice on everything in life.
Absolutely. Continue learning through REIT Ball. Reach out if you have any questions on other resources where you can find more information and learn even more. We want to hear from you. Make sure you like the video. If you're watching on YouTube, like and follow and subscribe on the podcast and YouTube. Click on notifications. Help the algorithm to continue to grow so we can keep spreading information and teach more how to get involved in real estate in an affordable way while protecting their capital as well. So that's all I have. Until next time, Spurlock, thanks for joining in and sharing your expertise on the sports side and engaging with us today. All the listeners out there, take care until the next episode. We'll talk to you soon.
Goodbye.